Hello, everyone. Welcome to today's webinar of the Gerhard Center webinar series, The Aftermath of COVID-19, the New Social Impact Ecosystem. Today, we're very honored to have with us Micheal O'Leary and Warren Valdmanis. The speakers will focus on impact investment, its promises and pitfalls, the broader movement towards sustainable and socially responsible business, and the need for investors to lead the charge. They will refer to the latest book, Accountable, The Rise of Citizen Capitalism. Micheal is the managing director at the investment firm Engine Number One. Previously, he was on the founding team of Bain Capital Social Impact Fund and invested in consumer, industrial, and technology companies through Bain Capital Private Equity Fund. He's been featured in Bloomberg, Fortune, Vox, Financial Times, Business Insider, and Market Watch, among others. Micheal has served as an economic policy advisor in the United States Senate and presidential campaign. He studied philosophy at Harvard College and earned his MBA from Stanford Graduate School of Business. Warren is a partner at Two Sigma Impact, a private equity fund that invests in companies that generate good jobs. He was previously a managing director with Bain Capital Social Impact Fund, and before that invested with Bain Capital private equity team for over a decade. He grew up in Canada, lived and worked in Australia, Chile, France, Hong Kong, Japan, South Africa, and the United States. He studied economics at Dartmouth College and earned his MBA from Harvard Business School. He lives with his wife, Christine, and 4 children in Portland, Maine, where it is snowing right now, right?
Just about, anyway, yeah.
It's really a pleasure to have you both, guys, and floor is yours.
Well, thank you, Professor Ani, and thank you all who have joined this talk. We're delighted to be speaking to you, joining you in Cairo, at least virtually, and delighted to be talking about this very important topic. One of the as you know, America is a great exporter, and one of its biggest exports has been at least the American brand of capitalism over the past 100 years or so, and that's really what we want to talk about today, which I think has had some really wonderful impacts globally, but also brings with it a number of challenges, and it's those challenges that led Micheal and I down this path of impact investing, which both of us used to do together at a large private equity investment firm in the US, and now we're doing separately at different firms. But this idea that investors can help change capitalism for the better is really the central theme of what we want to chat about with you all today. So we went ahead and we wrote a book called Accountable. And Accountable is a book about how to do that, about how investors and ordinary citizens can contribute to a more just and sustainable capitalism. And so what I'm going to do is just maybe spend a minute describing the premise that underlies Accountable and sort of the direction where we see the solutions. And then I'll hand it over to Micheal to talk a little bit about some of the challenges in implementing these solutions. And then we'll carry on a little bit further, and then we'll move it over to questions in about sort of 15 minutes or so. And so the premise that undergirds the book Accountable is as follows. It's that capitalism is fundamentally a good thing. Both Micheal and I are proud capitalists. And actually, if you look at capitalism's record over the last 250 years or so, it actually reads surprisingly well. So consider this for a second. In the 3 millennia up to 1750, global GDP per capita increased by just about 0%, which meant almost no changes to the standard of living over that long expanse of time. And since 1750, global GDP per capita has increased by 37 times. 37 times. So when you think about increased life expectancy, you think about decreased poverty, you think about greater abundance of food and technology, like the technology that's allowing us to talk today. All of this stuff didn't happen by capitalism, by accident. It happened by capitalism. And so, and by the way, capitalism has lifted over 1 billion people out of poverty in just the last 30 years alone. So this is a really powerful vehicle, but it's a vehicle that has a, we think, somewhat faulty steering wheel. And as practiced certainly in America and some other countries in the last 30 or 40 years or so, has brought with it a number of significant challenges. So let me give you one troubling statistic related to that. Michael and I used to work in Boston. In Boston, the gap between, the life expectancy gap between adjacent rich and poor neighborhoods is 33 years. 33-year life expectancy gap between a rich and a poor neighborhood. That is an extraordinary gap. This is in America in 2020. And by the way, that gap exists a gap of similar dimensions exists in most major cities in the United States. And that's because of the distorted results related to capitalism. In particular, things like the fact that whereas American workers used to see rising pay that was more or less tied to rising productivity in the country, from the post-war period to 1973, those two things moved almost in lockstep. Since 1973, we've seen continued growth in productivity in the U.S. economy, but basically flat wages for the average worker. And so we see a lot of things that are contributing to these distorted results. But in particular, one of the areas of focus for me is the way the ordinary worker is treated these days by American corporations. And so then when you step all the way back from that, you say, well, what is the issue? What are the issues that underline this? There's plenty of books out there written by academics or by virtuous CEOs that take different points of view on the issue. But there's very few books written about the nature of the corporation and how the corporation is fundamentally the key building block of capitalism today. And corporations touch us all across almost everything that we do, across almost every moment in our days, in ways that we sometimes don't even realize. And so Michael and I wanted to ask the question, how do we make the corporation more accountable to ordinary citizens? And the interesting thing is that this might have been a new idea 15 years ago or 10 years ago, but in particular with the advent of COVID, you're seeing many more people talk about this, and you're actually seeing a number of things happen. So there's now over $100 trillion of investment capital out there that has signed on to the UN Principles of Responsible Investing. There are groups like the Business Roundtable in the United States, a very influential group of CEOs, and the World Economic Forum that have said we need to think more about stakeholders in capitalism. And with all this talk, you would think that maybe all these problems that capitalism creates, whether it's inequality or climate change, maybe they're on their way to being solved. But the issue we found, and this is something that Michael will explain more, is that even though business leaders are making commitments to social change, so far the rhetoric has outpaced the action. As Michael likes to say, we're winning the battle of ideas, but we're losing the war of substantive action.
Yeah, no, thank you, Warren. I mean, there's really two visions of capitalism that are at play right now in the US, across Europe, across the world. And you would call one a vision of shareholder capitalism, in which corporations are run for the sole benefit of their shareholders. And the other is a version of stakeholder capitalism, where the purpose of the corporations is to be run for the benefit of all stakeholders. That includes workers and customers, that includes communities, the environment, as well as earning a fair return for their shareholders in the end. And one common way to tell the story of the last 100 years of capitalism, at least in the United States, was that after World War II, in this period that Warren was describing, when workers' wages were going up in line with productivity, we had a form of stakeholder capitalism where CEOs saw it as their duty not just to maximize profits for shareholders, but also to create real benefits for their communities and the rest of society. And that since 1980 or so, we've seen a much more shareholder-centric form of capitalism, where companies are run for the sole benefit of shareholders, trusting that through the competition with other companies, through government regulation, that competition, that the invisible hand will then create benefits for society. And what we're seeing today, as Warren was starting to allude to, is the ascendancy of this earlier form of capitalism, this stakeholder form of capitalism. And one of the ways you're seeing it is in the rise of socially responsible investing or impact investing. Warren and I both come from the world of impact investing, where investors are trying to earn a financial return, as they usually are, but are also trying to affect change on specific environmental or social issues, trying to create jobs for the unemployed or trying to restore the environment or fight climate change through a profitable company, not through donating money, not through government action, but through business. And over the last couple of years, one of the big changes we have seen is in the rhetoric of a lot of the most powerful people in the economy. So the Business Roundtable is a group of 181 CEOs of the largest, most powerful companies in the United States, which means the largest, most powerful companies in the world. And in the summer of 2019, they came out with a statement saying, we see the purpose of the corporation not just to be maximizing profits, but to be creating all these benefits for workers, for customers, for communities, for the environment. And for folks like Warren and I, who are big believers in this movement, it was a heartening statement to see that companies might be turning a corner and focusing on more than just maximizing profits. The problem, though, is that in a capitalist system, the capitalist is king. And following the Business Roundtable statement, another group, the Council of Institutional Investors, which represents big asset managers and asset owners, like pension funds or like asset managers like State Street or Vanguard or BlackRock, these massive multi-trillion-dollar asset holders in the US, that the Council of Institutional Investors came out and said, in response to the Business Roundtable statement, a reminder that CEOs work for shareholders, and that it might be nice to talk about all the different virtuous things companies are doing, but that any gestures at social responsibility are only tolerated insofar as they are insincere. In other words, that CEOs can say whatever they want about how their companies are doing good things for the world, as long as they're continuing to actually maximize profits for their shareholders. What the problem, though, is that we have created a system where CEOs are now having to manage multiple contradictory demands. They're being told by governments and by workers and by customers that they should be doing good things for the world. And at the same time, they're being told by many shareholders they should be maximizing profits. And faced with these conflicting demands, too many CEOs, too many business leaders are responding with a sort of rational hypocrisy, where they say different things to different audiences and continue to do what they've always done, which is try to maximize short-term profits. With my favorite example recently being the proliferation of corporate social responsibility reports from big corporations, where a massive conglomerate, a massive multinational corporation will put out a report about all the good things it's doing for the world, and then it'll put out a separate report about all the good things it's doing for shareholders. And oftentimes there's no connection between the two. And this reflects a sort of split personality disorder that's happening in a lot of our corporations, where rather than changing what's at the core of what they do, they're changing something at the edges. They might be donating money, but they're only donating a fifth of 1% of revenues to a given cause while leaving the underlying operations unchanged. And so here's the result that we're living in today. You'd be hard pressed to find a leader of a large global corporation who doesn't at least pay lip service to the idea that corporations should be doing good things for society. If you do a poll of business leaders in the United States, 9 out of 10 will say the corporation should be serving a broader group of stakeholders than just shareholders. The problem is if you then ask those CEOs, are they satisfied with the job their corporations are already doing? 96% will say, yes, it's important to serve stakeholders and my company is already doing a great job. And that is the struggle with this movement right now, is that you've got a lot of good intentions, but not much accountability for holding corporations to those intentions. And ultimately, we don't believe that capitalism has a publicity problem, that the reason why people dislike capitalism is because of a problem in marketing, that we're not talking enough about its benefits. We think that capitalism and too many of our corporations today have a purpose problem. And to fix that, Warren will talk a bit about the ways we can hold corporations accountable to a deeper purpose than just profit.
Yeah, and this notion of purpose, a lot of corporations these days talk about purpose as though it's something new. The truth is actually purpose as an idea goes all the way back to the original founding of corporations. When corporations first started being incorporated, they had to actually explain why they wanted to exist to whatever to the crown or to the government, because fundamentally corporations were viewed as social instruments. So you would say, I want to start a corporation for the purpose of building this railway, or for the purpose of delivering this food in this way. And the interesting thing about that is that while governments used to grant the privileges of incorporation, which by the way are substantial. When you incorporate, you have limited liability, so people can't come after you, the owner, for the debts of the company. They have other privileges like the ability to divide up and share stocks that get regulated by governing bodies. So these privileges were only conferred on businesses that had a purpose that made sense from a broader social perspective. And most articles of incorporation in America today still have a purpose clause. But what they actually say, for the most part, is to do what is lawful in the state of Delaware, or something similar to that. In other words, the purpose that used to underlie corporate behavior has been stripped in all but the form of the actual legal documents. And so this is this lack of purpose in corporations, we think is a big deal. In America, again, 50% of white collar workers can't explain why their jobs exist. Another 50% of workers describes themselves as disengaged, but 13% of them, that's 1 in 8 workers, is so disaffected by how they're treated on the job, they actively work against the interests of their employers. What all this means is a lot of folks working for corporations aren't doing very well by the corporations because they don't even understand why the corporations or their jobs exist. So this is both a social problem and a very real economic one as well. Now, you're beginning to see some meaningful shifts in the right direction. The French food giant Danone, just a few months back, decided to incorporate its purpose into its charter. So it describes its purpose as to bring health through food to as many people as possible. We believe that actions like this are really important because fundamentally, purpose is the most distilled form of strategy. It's very difficult to make strategic trade-offs at a corporation if you don't know why your corporation exists in the first place. And I have found, and Micheal has found, in our work as impact investors, when we help a company to clarify and better articulate its purpose, the company stands to perform much better, not just in terms of its social impacts, but also its commercial ones. And so, and incidentally, there's a lot of talk about this ESG stuff, environmental, social, and governance issues, which are related to, not exactly the same thing, but related to purpose. And we're increasingly seeing studies out there that suggest that people who perform strongly on these items also perform well as corporations. So in some ways, many of these things that we're talking about are just good housekeeping, just good corporate practice. But one of the important things to note, though, is if there isn't appropriate follow-through, as Micheal will talk about, there isn't appropriate follow-through all the way through the organization, opening this Pandora's box can actually be quite challenging for corporations, as you see with all the employee protests that we've seen across many corporations in America.
Right, it's not enough for a corporation just to state a new purpose, because we've had decades of companies talking about a mission statement that's bandied about on their website or is in a glossy brochure they hand out at their annual meeting. If we want to see real change from corporations, we need mechanisms by which we can hold them accountable. And one of the clearest ways, and this is, I think, the last thing that Warren and I will cover, and then we're excited to take all of your questions. One of the clearest ways you can hold companies accountable starts with metrics. If you think about financial metrics in our public markets today, now this is true in the United States, it's also true around the world. We have an entire system in order to keep companies accountable to the sorts of results that they're reporting. So in the US, for a company to report on its financial results, those results are overseen by something called GAAP, the generally accepted accounting principles, overseen by FASB and the SEC, audited by PwC, EY, KPMG. It is this alphabet soup of accountability, but it works. When you want to see what a company's net income was or what its revenue was, you can trust the numbers, for the most part, that you're seeing. And as a result, if you were to look up right now on Google, what are the 10 largest corporations by revenue, you'll see the same 10 companies show up on every list, because we've all decided on what the rules should be that govern the way companies should report. But once we start talking about environmental and social metrics, things like carbon emissions or the diversity of a company's workforce or the health impact of the food that it sells, once we start talking about these social environmental metrics, we lose all that standardization, all that oversight. So as a result, depending on what data provider you're looking at, or what rankings or ratings system you're following, you'll see big companies like Facebook either show up as the most socially responsible or the least. You'll see big financial institutions like Wells Fargo in the US as either being the best governed or the worst. Because there's no agreement on what these metrics should be, how we should assess, how we should judge these companies. So one of the most important things we need to do to start holding companies accountable to a deeper purpose than profit is agree on some system of metrics. And you're seeing some motions in this way. The big international standards body, the IFRS, is currently discussing how to start thinking about how to start tracking these metrics. The World Economic Forum put out a proposal of what metrics big companies worldwide should start to follow, in addition to the financial and operational metrics they currently follow. But we're still so far from even knowing what are the carbon emissions that most companies have, or what is the diversity of most companies' workforce. And the second big area we need to bring accountability into corporations is through each of our roles. And we called our book The Rise of Citizen Capitalism. That was a subtitle, because we do see the role that all individuals can put pressure, put influence on companies to get them to better reflect their values. So one of the most obvious ones is as a consumer. We've seen a long history of consumer boycotts when companies kind of act out of bounds with consumer values, but also in more traditional ways. So for instance, in the United States, the largest purveyor of organic food is not a health food store like Whole Foods, but it's actually Walmart, this big box, massive retailer. And the reason is not out of some do-gooder desire to save the world. It's because that's what consumers are demanding. And it's a good reflection of the way in which consumer preferences ultimately are reflected in the actions of corporations. The other example is just in the last month or so, General Motors, the largest car company in the United States, announced that by 2030, all of its cars will be electric. They'll no longer be making internal combustion engines. And again, that is a reflection both of beliefs at the very top of that organization as to what it will take to succeed long-term, but also a reflection of our desires as consumers that we're putting on those companies. And the same is true in our roles as employees, as investors, something I hope we get more into in the discussion, and ultimately as voters as well in our government. Now, the last thing I'll say before we open it up is, I think one reason why this movement is so important is that there's currently a crisis of trust among many of our corporations. If you ask people whether they trust their local small business, the kind of store on the corner, that 3/4 or so say yes, they trust that local company. But if you ask them, do you trust the big multinational corporations that so dominate our economy, so dominate our society, it's exactly the reverse. That only 1 out of 4 people say they trust. That only 1 out of 5 people will say they trust CEOs and business leaders to tell the truth and to act in a way that is generally ethical. And the big risk we're facing today in this broader movement to make business more responsible, to make capitalism more sustainable, is that done halfway, where we say all the right things but don't actually change the way our corporations act, it can further break that trust. That little bit of trust that's remaining, it will continue to erode as people suddenly realize that they've put their faith in a group of leaders and a group of companies that don't actually intend to change in a substantive way. And that's what Warren and I are trying to do, both through the investment funds that we're working at, but also through this book, to show how in which we can hold companies better accountable to the sorts of high-minded rhetoric that their business leaders are currently espousing.
So that's Ali, we'd love to take questions now.
Sure, sure, sure. But please, if you have questions, please send it via the chat box. I have few comments and few. I like your expression, rational hypocrisy, by the way. But there are lots of issues that are. The first one is education. Education creates a mindset, and the mindset is just not there. I mean, when we talk about business schools, we still teach them the Milton Friedman doctrine of profit. We rarely hear somebody talking about, for example, Peter Drucker has a saying right from the 60s. He was saying making profit is like inhaling oxygen. You need it to live, but you don't live to inhale oxygen. So apparently, the analogy here is that there is a purpose for a corporation. And it's interesting when you look at some corporations that started in the very beginning. I mean, especially the chocolate ones, amazing. Hershey, Mars, even Cadbury in the UK. They started with a clear social mission of a community, and they have a very deep sense of the community they live around. But then things have changed. Once you start getting into the shareholders' mindset, an example is Cadbury, for example. So the ownership is a very strong determinant, the mindset of the owner. If you have a family owner that is or foundation that is owning some, but the assumption, can you really expect that a company by itself is going to be coaxed or nudged into being socially responsible or having a purpose that makes sense to the stakeholders? Does that make sense, or do you really need a little bit more than that?
No, I think it's a great point. And one thing that we try to do in the book is the story most people tell about the development of capitalism over the last 250 years, 300 years, is to focus mostly on the way different tools develop, the steam engine and changing the means of production. And a different way to tell that story that we tried to do is to look instead about how ownership has changed over time. Where if you go back to 1776, when Adam Smith wrote The Wealth of Nations, in many ways, the Bible of modern capitalism, that when he was writing about the invisible hand and the importance of competition, about how it was private vice that made for public virtue, his economy looked dramatically different than ours does today. So for instance, nearly all economic activity in the 18th century was happening on small local farms, in small local workshops. In fact, the few companies that did exist, the few corporations that did exist, the big trading corporations like the Dutch East Indies Company, Adam Smith was actually worried that they were subverting this market ideal he was writing about in The Wealth of Nations. And so you roll that clock forward to today, what we see now is our market is not dominated by small, locally owned small businesses where the owner is friends or neighbors with his employees or her employees, where the environment, if the company pollutes the environment, it's their environment that they're polluting. Now our economy is dominated by massive corporations that in most cases, especially in the United States, are not owned by individual families or foundations. They're owned by thousands or tens of thousands or hundreds of thousands of individual shareholders all over the globe, anonymous. Most shareholders, they probably could not even tell you what companies they own because they own them through this long, complicated string of pension funds and mutual funds and financial advisors. So what do you do with that? I mean, there are some philosophers who would say the answer to capitalism has to be a return back to a smaller, more intimate, more locally owned version. In the US, a big popular trend now is to buy your groceries at farmers markets, where local farmers come and sell their wares, sell their goods. And that should be the model for the way we build our economy. The problem, of course, being as reasonable as Warren and I try to be, is that to go back to an economy that looks like Adam Smith's, we'd also have to go back to a level of income and level of wealth that exists in his age. It would essentially mean decreasing the standard of living by 90, 95, 98%. And so instead, we have to somehow figure out how through our existing financial system, where the end shareholder oftentimes is deeply intermediated by financial advisors and by pension funds and all else by the companies they ultimately own, how do we create a through line so that their values are ultimately reflected? And I think that's where we get to something like purpose. Every company should have a deeper purpose, metrics, and a real role for government to be setting the restrictions, the bounds by which companies act, both on a national level, but also on a multinational level.
Super. I'm going to take some questions from the audience because we're starting to accumulate many questions. I'll let each one with a question to sort of unmute, turn your video on, and please ask your question. We'll start with Farida Ali. Farida, please unmute and turn on your video and ask your question, please.
I see Farida there, but no, still on mute.
Okay. Okay. We'll take your question later on then. We'll move on. Hind Abu, Dr. Hind. Hold on a second. Dr. Hind, would you unmute yourself, please?
Yes, I was unable to unmute myself.
Sure.
Hello, how are you? Fine. Thank you very much for this nice presentation. I have actually 3 questions. The first one is, how do you see capitalism might affect education reforms in the MENA region? The second one, do you think that the neoliberalism ideology can affect the economy of the Gulf and the Arabic region, and how? And the third question, because I've been reading this book about moral capitalism for Nicholas Kristof, he mentioned that capitalism is not very moral in the way that the Harvard economist Richard Freeman has mentioned, that capitalism will push us into this vicious circle of the rich is getting richer and the poor is getting poorer. I would like to hear from you some of your thoughts. Thank you very much.
Well, thank you, Dr. Kassir. You know, I wish I could comment more directly on things in the Gulf region. I think perhaps Professor Anwi can actually give us a little bit, because I actually had a couple of questions for him. But on the subject of, is capitalism moral? This is a topic that we spend a bunch of time talking about. And you know, we think capitalism is only as moral as we make it. You know, capitalism, like any other social institution, is comprised of people and people with values. And our observation, you know, having spent a lot of time, you know, traveling in capitalist circles, obviously, is that most capitalists actually do care about things like climate change, and they do care about things like their workers, and they do care about things like, you know, whether their companies are having a positive or negative impact on their communities. I think most capitalists do care about those things. So in that sense, it's moral. But to the extent that it's those morals aren't getting through, you could question whether the system, you know, does an effective job of communicating morals, of that through line that Michael talked about. And so a little bit about, you know, what impact investors are trying to do is create a better linkage between the morals of individuals and their expressions in the capitalist system. So, you know, as an example, the investment business that I've helped to found recently is organized around the idea that, you know, investing in workers is actually a really good thing, that you can create good jobs, which will ultimately create more valuable companies. Sounds like a radical idea, but the idea here is we're setting out to do that. That's not what every private equity firm in history has done, but we're setting out to do that with the belief that it's going to be commercially successful, but also that it's rewarding for the folks who are doing that, the people, you know, the investors who are participating in the strategy, the individuals who are actually, you know, executing the strategy, that this is something that has a purpose that goes beyond, you know, just returns. And impact investors get to think in those terms and get to actually sort of use their express their morals more directly through their work. And we think that capitalism could benefit from more of that kind of stuff. Michael is doing a similar thing in public markets.
Yeah, no, I mean, ultimately, I would say that capitalism is only as moral as we are, and that, you know, this idea of an invisible hand guiding the markets, the markets are purely a reflection of each of our individual decisions. There's an example in the United States of an American football team that was called the Washington Redskins, which is considered a kind of an epithet or a slur for Native Americans. And for a long, long time, they refused to change their name. The owner of that business had told a reporter, "We will never change our name. You could put that in all caps, never, NEVER." And never became last summer, as the pressure on them to change from consumers, from advertisers, from other companies became great enough that it forced them to adapt to people's values. And it's possible that we could have said, well, what are you going to do? It's a privately owned company. That's capitalism for you. But ultimately, he had to bend to the pressures of the market, just as Walmart starts selling organic food and GM starts selling electric cars, because that's what people demand. And the problem, I think, and something we really try to dispel in the book, and something that I think the impact investing world is doing very well, is that for too long, we've kind of bifurcated our lives into one part moral and one part economic, where we sort of give ourselves permission to say, I'm going to maximize my money during the week so that I can give it away on the weekends. And you see that through a lot of folks in the United States who amass a huge fortune as investors or as business people, and then give it all away. There's the giving pledge that Bill Gates and others have signed on to, where they've pledged to donate 99% of their massive wealth. So it's not that they're bad people. It's that they just see themselves as separating out these activities of making money and then doing good. And that's what impact investing is trying to reject. It's trying to say, if you care about creating jobs, for instance, you shouldn't make all your money firing workers and then donating that money to a nonprofit that tries to create jobs. You should just try to create businesses, find business models where you can do everything at once. And I think that's the hope that impact investors are leading the way with.
Okay, thank you. Do you have more questions? I'm sorry. Dr. Hind, do you have more questions?
No, I'm fine, but he didn't answer the part where how do you see capitalism affect the reform of education in the MENA region, and the part relating to
that's out of their scope of expertise.
Okay.
We can talk about this offline.
Thank you.
Okay.
Thank you.
Sure. Farida, you're next. Could you unmute, please?
Yes, Dr. Ali, could you hear me?
Yes, I can hear you. Please ask your question.
At first, I think that the government activities should be separated from the market activities in order to enhance the fruits of social capitalism. Is this true or not? Because I think that the government role should be articulated within the watching the rules of the capitalist market. This is the first question. The second question is, the second thing that I would share with you, that I liked both concepts shared today in this webinar, which are the irrational hypocrisy and the family concept. But I think that each strategy is adopted according to the size of the corporation. If the corporation has a large size, then the stakeholders are a larger number. So the family concept cannot be adopted in this case. I think that rational hypocrisy would be a better strategy to adopt. However, if the number of the size of the corporation is smaller, I think that the family concept will be more rational. That's all. Thank you very much.
But I think, Farida, you mentioned, thank you for the questions. You mentioned the role of government, and our observation, in the book is that government, we've set up this system where government, is sort of in opposition to corporations. That government's this watchdog, and corporations are supposed to go and do whatever they can within the letter of the law, or even to the edge of the letter of the law, and then government's meant to go around chasing them. And we think that setup, unfortunately, that sort of adversarial setup isn't working that well, because when government's viewed as sort of this enemy, this sort of watchdog, and corporations are viewed as it's legitimate to do whatever you want inside the letter of the law, you end up in this situation where corporations often outfox government. They often are able to stay one step ahead in pursuit of their, narrowly understood self-interest. And so when we talk about citizen capitalism, what we mean by that is, individuals expressing their values in whatever it is they're doing. So expressing your values at the ballot box, expressing your values in your capacity as a shareholder, expressing your values in your capacity as a worker or a manager at a corporation, and furthermore as a customer, making the dollars that you spend, work for you from the point of view of your whatever it is you think, whatever it is you value about capitalism. So our view is that yes, of course, government has an oversight role. But to have it be the case that corporations do whatever they want as long as government can't catch them, we don't think that's a very productive system.
Yeah, no, there are certain things though that we put this in the book when we have a chapter on what role can government play, because I think a lot of people who believe in the same sorts of general goals as Warren and I, greater inclusivity, greater equality of opportunity, more sustainability, that they say all wonderful things, but we already have an organization that can force corporations to do that, and it's called government. So we try to dispel a little bit of the idea that government can solve all these problems. One good example being in the United States, we for years and years and years we've decried the sort of inequality that exists within corporations, where the CEO who used to make maybe 30 times as much as the average worker at a company, if you go back 50 years or so, now makes 278 times as much as the average worker. So the skyrocketing inequality, and maybe not surprisingly because of that, and it's so public, it's so visible, it's so visceral for people to get worked up over. Government has tried to step in over the last few decades, in mandating and restricting the amount of executive compensation that happens. But time and again, many of the things the government has tried to do have ended up, if anything, making some of these problems worse. So for instance, governments across the world had the idea of maybe if they had to make the executive compensation packages more public, that the sort of public shaming mechanism might be enough to have CEOs rein in their compensation. And so in Canada, for instance, they put in a new policy maybe 15 years ago of disclosing executive compensation. In the United States, it happened much longer, but more recently, they had them start disclosing executive perks like use of a private plane or otherwise. And one thing that we see when that happens is not a waning inequality, but in fact an exacerbating one. Because what ends up happening is once CEOs know what all the other CEOs in their industry are getting paid, when it comes time to negotiate for their own pay increase, what they say is, here's the average. I'm an above average CEO. In fact, I think I'm a top quartile CEO. And the boards who they're negotiating with say, well, it's our job to find the best CEO. And so we agree, you're not bottom quartile, you're better than average, maybe you're top quartile. So that CEO ends up getting a higher pay package, which then raises the average, raises the top quartile, which then the other CEOs, when they're negotiating, the same thing happens. And so the academic studies show that when you increase disclosure in this way, that something that was meant to limit executive compensation actually exacerbates it, makes it even worse, which is just one small example of I think, the risk that comes from trusting government to be able to solve all of these problems. In the case of executive compensation, we think it's more of a failure of corporate governance, of boards overseeing CEOs, of responding to the best interests of shareholders, than it is a problem of government. But that's not to say that government doesn't have many areas where they are the only actor, where they're the only one that can solve certain problems. So for instance, in adding a price to externalities, something like carbon emissions is a great example, and a very hot button issue in the US over the last decade. Right now, it is free for a company to emit carbon, even though that carbon then extols a cost on society of somewhere between $50, $100, $150 per ton of carbon emissions. Until government puts a price on that, starts putting a tax on that carbon, that it'll always be in the best interest of the company to, if they're looking at similarly priced technologies, to go with the one that they don't have to worry about renewable technology or taking on a greater expense. In other words, until we put a price on carbon, we are in many ways subsidizing that sort of pollution. And that's sort of actually something only government can do. That's not something that that companies will self-regulate around. And we think it's the same thing with providing public goods like education, and we think it's the same thing with ensuring there's fair competition in the markets, such as through antitrust, and fair bargaining, such as through allowing the right to organize. So these are the areas I think that even though government can't solve all problems, there are certain things that only government can solve.
Lovely. We got actually many questions about government, and you guys answered them all. So anyway, question now is from Hani El Shahawi. Please unmute yourself, sir.
All right. Can all see me all right? Yes, thank you very
Yes.
much for the very interesting and engaging dialogue. Several things I wanted to do, but first I'd like to ask you, what do you think about the role of technology? My last role was working on digitalization, specifically at Shell. And the way I see it is that the rate of change has started to outpace the ability to regulate. And as time goes on, regulators and lawmakers in general, governments included, are going to get further and further behind, both technology and business model evolution. So that presents obviously challenges, but also it makes the role of corporations that much more important. And then the other one, sort of related to that, is the increasingly intangible nature of companies in general. So traditionally, it's assets like buildings, plants, machinery, things you can tax, for example. And it's really flipped the other way. So a lot of it of the value is intangible value, patents, brands, intellectual property, and what have you. And again, that renders the application of traditional economic tools of competition and regulation that much more irrelevant. So I just wanted your thoughts on those 2 points.
Happy to take a first crack at this, Hani. Thank you for the questions. I'll take your second one first on the question of assets. As you correctly point out, I don't remember the exact statistics, but the vast majority of equity capital out there used to be associated with hard, assets like factories. And now it's like you said, it's patents and brand and IP. You didn't mention workers. But one of the other things that doesn't show up on the balance sheet is workers. It's funny because when you make an investment as a corporation in America today in technology or in a factory or in purchasing of IP or patents, you tend to get credit for that. When you make an investment in your workforce, training or other things that have happened over the course of the pandemic, you often get punished savagely by the stock market, which is a big issue. My own view on the asset side of things is that it makes it all the more in the corporation's interests to be thinking thoughtfully about their stakeholder relationships. Because if you're not investing in your workers, if you're not thinking long term about your customer relationships, if you're not partnering more effectively with your suppliers, I think your corporation fundamentally it depends on those things more than it ever did before. 100 years ago, when there was a Ford factory that had a huge plant, it was depending for its comparative advantage on the scale of its plant. Now you're depending for comparative advantage on your relationships more than ever. On the technology side of things, I'd say one observation, and I'll let Micheal comment, but one observation is, as you said, it means corporations are becoming all the more powerful, and technology, of course, can be a force for both good and for ill. I get to work at a company where one of our core assets is the ability to use data science in investing, which is a super cool, powerful technology because we're now using data science to invest in workers. We just invested in a vocational training business where we're trying to use data science to make it a more effective business. And so technology can be a massive force for good if guided with values, but left unbridled, it can be quite dangerous, as we've seen. And so my own view on the technology question is that it just makes values inside of corporations and the values of owners transmitted through to corporations all the more important.
Well, and I'm very glad you also brought up, when you're talking about tech, you brought up new business models. Is one of the things that we really focused on in the book is we get this critique all the time of, there must be a trade-off trade-off between doing the right thing for your customers and making money. Because can't you always just cut wages a little bit for your workers and increase net income? And so there must be this tension. And one of the things that we love being able to surface were these examples of companies who are creating new business models, truly innovative business models, oftentimes enabled by new technology that eliminated that tension. And so one example is in the payday lending industry in the US. So in the US, if you wanted to get a short-term loan, in advance of your paycheck, you can pay astronomical interest rates. You can get mired in a spiral of debt where you end up paying 5, 6, 7 times as much money on interest and on fees as the amount of money you actually took out initially. And so as a result, not surprisingly, it's been an area of intense focus from a regulatory point of view and intense ire from a lot of the American public. But a new company came along a couple of years ago called Earnin that took a new business model, an innovative business model approach, where what they did was thanks to developments in technology, were able to plug into the time and attendance system at companies. So they knew when someone came to them for a loan, they could actually see on a real-time basis exactly how many hours that person had worked this week, today, this month. And as a result, when they gave them a loan, they were able to dramatically lower the risk that they weren't going to get paid back. They were also able to, again, through technology, put in place an ability to, once the employee did receive their paycheck, they could auto-deduct the amount that they were owed, again, reducing the risk. And as a result, they were to create a business model where instead of charging these astronomical interest rates, they charge an optional tip, as in the customer could decide after receiving the service whether or not they'd received any value from it. If they did, they could give a tip. If they didn't, they could do it for free. And it's this kind of radical business model that they put so much trust in their customers. And as a result, kind of created this community of trust where they got it back in return. And the customers tipped on average, I want to say 1.5%, 2%, something like that. Enough though, that the amount of money that Earnin ended up making was commensurate with almost what a traditional payday lender would have made, but at much lower risk and without kind of the extortion that might happen in the customer base. And so the one thing I agree with everything Warren said, and just one thing I would highlight is this kind of exciting new development around business models that better align the incentives of managers and shareholders and workers and customers. And maybe the other example, I'll leave you with another area I think is really exciting and touches on some of the education questions people had earlier, is around coding academies in the US. These schools where you can sign up part-time or full-time to learn how to code, transfer into a more high-tech job. And a lot of the coding academies, the way their business model is structured is instead of charging you a tuition, which the customer has to pay whether or not they got any use out of their degree, whether they got a new job or not, now they're saying, come, we'll give it to you for free. But if you get a job in the tech space where you're using the new skills we taught you, we'll take some percentage of your income up to a cap for a limited number of years. And again, what this does is it fully aligns the incentives between the provider, the shareholders, and the customers in a way that I think is really exciting and innovative.
Lovely. I have a question from Raymond Sanner. Please, Raymond, please. Would you unmute yourself, please, Raymond?
Right. Yeah. I think you hear me now, right?
Yes.
Okay. Well, thank you very much for a very interesting presentation that you two shared. In terms of my question, and I'm aware of time, we're running out of time. I just wanted to ask you, you two are sharing this presentation. As you know, in a larger context, the sharing is done by cooperatives, has been for quite some time. What is your take in regards to cooperatives? Could that be a model to cope with the contradictions that you have so well described? Could it be a future model also? In the country I'm living in Switzerland, we have cooperatives for quite some time. Actually, they're about 10% of GDP are produced by cooperatives. However, there's a gap of knowledge in our management schools and universities. There's not a single person teaching management of cooperatives. So if that is this the case, But on the other hand, maybe it could be a future model to cope with these contradictions. How do we fill the gap in terms of knowledge, and how to pass this on maybe to the young who could start not just another startup, but maybe a collective startup as a cooperative? That was my question. Well, thank you.
No, I love the question. It's a topic dear to my heart. Before I was even in impact investing, I had helped write and then pass a budget amendment in the state of Massachusetts funding a center for employee ownership. You know, they would fund the development of worker cooperatives, of employee-owned companies, of the conversion of small businesses becoming employee-owned when the founder was leaving. And so I'm a big believer in the cooperative model. And I agree with you that it is an area that is not touched both at the kind of business education level often and in the kind of broader discussion. I think in the US, the one area it shows up is through something called an ESOP, an employee stock ownership plan, which is sort of a weak version of what you're describing. I think the reason why Warren and I didn't focus on it more in Accountable or in our remarks today, even though I think you're right, in many ways it captures the same sort of feeling of bringing the workers into the boardroom, you know, aligning incentives, making give everyone a real stake, a financial stake, as well as a broader stake in the corporation's success, is, you know, in many ways we have to deal with the economy we've currently got. And so from what I've seen so far is, you know, if you're starting a new business and started around that sort of model, or if you're dealing with, you know, in the US right now, we've got, because of demographic shifts, a huge wave of retiring business owners who are trying to figure out what to do with the small business they're selling. You know, at that scale, there's some pretty interesting things around how to convert to employee ownership. We're talking about the scale of massive, big public companies, you know, $200 billion companies that are already owned by tens of thousands of shareholders. The transition is much more difficult. You know, where does the capital come to buy out those sorts of shareholders? How do you change, you know, if we have a hard enough time just putting purpose into a company's charter, how do you change the deeper forms of the charter to be more broadly around employee ownership? But I will say there has been, especially in the Democratic primaries in the US last year, from Bernie Sanders, from Elizabeth Warren, some of the politicians more on the left, there have been suggestions around, as a first step, bringing employees into the boardroom, you know, creating, say, 40% of all board shares just for workers of the company to hold. And so I think, you know, you are seeing this become a bigger part of the conversation. It'll be exciting to see where it goes.
Yeah, I think Raymond, I wish we had more time, because I'd love to hear more about, you know, about your thoughts on how we could teach that topic. I went to business school myself, and we didn't talk about it, which is a shame, because I do think there's promise in that model. I also think there's promise, as Micheal said, there's promise in many of the things that are done, particularly in Germany, but elsewhere in Europe, with regards to worker voice and worker enfranchisement in corporations. Some of those things we're trying to learn from in the work that we're doing now. I would just say, you know, much of what Micheal and I are speaking about is sort of shareholder capitalism as practiced in, you know, sort of United States and America, in particular, United States of America and Britain in particular, over the past sort of 40 years. There's obviously lots of different kinds of capitalism, and our hope is that, you know, we can learn from some of the other practices out there. I'll just say that, you know, having studied also economics, and having learned a lot about Adam Smith, the person that a lot of folks hold up as the sort of paragon of capitalist virtue, with this notion of the invisible hand, and everything ultimately sort of works out if you just let the market decide. You know, Adam Smith also said, the wise and virtuous man is at all times willing to put his own private interest should be sacrificed to the public interest. He should be willing that his private interest should be sacrificed to the public interest. And this is Adam Smith. And so I just think it's important that we realize that capitalism isn't some sort of pure Adam Smith thing. It's actually a thing that's formed by humans, and we should learn from each other, as you suggested, Raymond. But this has been, anyway, I'm personally optimistic, but we got a lot of work to do.
I'm going to take last question from Ahmed Ismail. Would you please unmute Ahmed and ask your question? Ahmed, are you? Well, maybe, I don't know. Anyway, so let's wrap up. Last comment. When you talk about purpose, we actually had a speaker almost 5-6 months ago, Colin Mayer from Oxford University. And Mayer is part of a group from the British Academy to define the future of a corporation. And his definition of a purpose, he says the purpose of a corporation should be to solve problems that benefit society and environment and not cause problems. It's a very interesting way of looking at it. Colin Mayer also is very engaged with something called the Economics of Mutuality, which is headed by Bruno Roche, which is, again, we brought them in. This tends to be more like a European branch or a European wave of the movement. But interesting, I mean, once you get more people talking about it, hopefully it will become a mass scale movement. I really thank you for an excellent, thought-provoking discussion, where I really recommend the audience to read your book, Accountable. It's really an eye-opener. Thank you. Thanks a lot.
Thank you. Thank you all.
Okay, guys, thank you. And I look forward to seeing you on Wednesday. Our title of our webinar is Mobilizing Private Capital to Speed and Scale Up Social Innovation. This is by Vanina Farber. She's an area professor of social innovation at IMD. I look forward to having you all there. And again, I thank my two dear guests, Micheal and Warren. Thank you.
Thank you, Professor.
Thank you.
Bye.
Take care all. Bye-bye now.